Another down date for stocks. I'm with Ben Willis, CEO of Princeton Securities. Ben, I guess this isn't really surprising when we see the market drop 300, bounce a little bit, and go back down.
Every trader that I have respect for is looking to buy this market, but all the indicators we traditionally use have not given us a clear signal. The VIX trading to the downside today when we're hitting our all-time lows. The Russell, again, continuing to underperform. You would think if the American economy is doing as well as it is, that the Russell should be the shining star in this, and yet it's underperforming all the major indices. So two of the major ones that most traders are looking at, hoping to get a clearer signal that it's time to buy, and we're not getting it right now.
We had just a short time ago, S&P cut its sovereign debt rating on the UK from the highest possible level. It took it down a few notches. What was the reaction when that happened? What do you think that means beyond this moment? You find it a yawn.
Oh, just the S&P is like the IMF. They're an institution, but they don't have a lot of value anymore. They've missed a call. Anybody who didn't think that once the vote came through, anybody who follows the financial markets knew that they had to be downgraded. So just that S&P may have been the first among the other several that are out there to do it shouldn't come as a surprise to anybody, and I don't really think it was a surprise for professional traders.
What's the difference in what you're hearing today compared to Friday after news of the vote happened? It's still a weak market, but how is it being processed and rationalized now?
It is very difficult. It's probably the single largest event I've lived through in the markets, other than I was here in 1987 in October. So we kind of fell under our own weight of our American markets, if you will. But as for a global event, the fact that so many people were on the wrong side of this trade, and nobody appears yet to have a real pattern, a real system in place on how to trade around this, to extricate yourself from with a high exposure, whether it's the European central banks or the European centered banks, and what to do with it. And I think that's what we're seeing is the markets continue to try and price themselves, and that's really what we're going through.
We actually have a question from one of the viewers asking if Britain's economy will recover.
Absolutely recover. It's the fifth largest economy in the world, but in terms of Europe, if to make it American, this would be the equivalent of California voting to cede from the United States. If California were on its own, it would be in the G7. It's one of the largest economies in the world, just in its own state. Great Britain was smart enough not to get their currency tied up with the EU, because I don't know if this would have been possible if they were still on the Eurodollar or the Euro. So will it recover? Absolutely. I still think I'm of the mindset that this was the right thing to do, that the creation of the European Union is one of the great political, economic blunders of all time. And it's going to take, as long as it took to create, they've been trying to do this for over 100 years. The European Common Market was the predecessor. We finally got into the European Union, we created a single currency and all that went with it. And it still to this day makes no sense, especially when you can have Goldman Sachs write a derivative that allows Greece to get into the game. That's not a real strong team I want to be part of, quite frankly.
Ben, people are trying to understand, investors are trying to understand the impact to the U.S. economy and the U.S. market. Do we fully have an understanding of that just yet? How do companies in the U.S. get hurt or helped by an exit?
The single biggest impact on those that do have exposure will be the currency translation. It should be a net benefit to the United States when this finally all washes out. The problem is with Europe, the European Union being such a large trading partner, the fact of the matter is London was not that significant a trading partner to the United States. I've heard numbers between 3 to 5%. So this really doesn't justify that type of move. So again, markets throughout the world, not just the United States, hate uncertainty. There is so much uncertainty around this because nobody really drafted a plan. The assumption by all the smart money was that they were going to stay. Now that they're not there, it's going to take a little while to draw up the plan and figure out where the chips will fall when all this settles down.
You mentioned the indicators that traders are waiting for to get into the market. Why do you think we're not seeing those buy signals flashing just yet? Is it that uncertainty around what's going on?
Absolutely uncertainty, but I think the single biggest effect, there was a piece out on Friday that was shared around the globe, so to speak, that there's estimated to be $150 billion of stock that must be sold for the quantitative funds to minimize or reduce their risk to the equivalent level of where we are right now. I think that's what's overhanging. So I don't think the dust is really going to clear where a trader wants to step in and say take them on any other sort of news data. We want to see exactly what's in play, and there does appear to be, because of the way the VIX is trading, because of the up volume, down volume, there does appear to be some very significant selling with hedging going on along with it right now. So for the trader, not just the long-term investor, just the traders themselves, are the ones I've spoken to, took a shot on the opening Friday, made a little bit of money, but if you didn't get out of it quickly, you're still underwater today.
And Ben, would you assume the stocks that perhaps start to show traction when this latest downdraft is over? Is it the typical defensive sectors, whether it's utilities or pharma or the like?
Absolutely. Utilities still manage to hold up. You continue to hear stories about the dividend-paying stock, the real estate investment trusts, especially those that are American-centric, that don't have any of the currency. So, again, I go back to the idea. One of my customers many years ago wrote a book out called One Up on Wall Street. His name is Peter Lynch. He started a little fund called Magellan. Said, buy only what you know, but save a little money to buy it when it gets cheaper. And he was one of the greatest investors of all time. He never went all in on any of his trades. So this is what you should be doing right now as a long-term investor. Have your shopping list. Everybody has their shopping list when they run out of what's in the pantry. Nobody has a shopping list for their stocks. You should have a shopping list, and when they reach the price level, that's when you should be going in.
We also have a question about bank stocks. They've been hit hard. Is that an area you would avoid at this point?
I would avoid international exposure. First of all, when central banks continue to try and manipulate their currencies to devalue, and we thought we were seeing a reversal of that, which is why the American banks started to trade up the way they were. The idea that the arbitrage against the Fed was going to be over and they'd get into the business of making money. I would avoid right now the high-risk trades like the European centralized bank, the ones that are in the news down 20%, 40%. The American side, I would be looking at the regional banks that are, again, American-centric and don't necessarily have the same concerns that the money center banks located in New York would
And
have.
just to define that, so you would avoid names like Wells Fargo or Bank of America or Citi or JP Morgan and look more to, when you say regional banks, the smaller. I just wanted to define that
yes,
because
regions,
some people might
right.
think, well, those
I
are
have to
in
be
my
careful.
region.
I'm not really supposed to talk about individual stocks
so
by
broadly.
rule, but broadly, I would avoid those big names you see advertised. But again, window research. Open up your window and take a look and see who's doing what out there. Automobile sales are doing just fine in the United States, hitting record numbers. Why is that? Because oil prices went down. We may not be spending at McDonald's, we may not be spending at Darden restaurants, but we're ask any of your neighbors who have a new car, ask what their payment is compared to last year. That's where the money's going. Your healthcare deductibles, you mentioned pharma. Again, one of the beneficiaries of the people that have the money, that are affected by lower gas prices, that have the spending power, have been forced to spend that on their deductibles, on their Obamacare.
Ben Willis, let's take a quick look at the markets before we go down. 277, you have any sense on where if we sell to the close or if there's an attempt to bid up?
I think you probably see a little bit of relief of the selling pressure, but that doesn't mean it's necessarily, again, my indicators. I would love to buy them. I'm not seeing it yet.
Ben Willis, thanks so much for your expertise on this. We really appreciate it.